Okay, now let's get to some of these questions. Someone just asked me a minute ago after we talked about options. He said, okay, I understand I should buy out-of-the-money calls at the low of wave 2 and sell them at the top of wave 3, but where do I buy them if you're in a correction? Same place. If you've had, if you have a 5, you want to buy them here and sell them here. If you have an ABC, you still want to do it at the wave 2 and wave 3. On the wave 2 rally, you want to buy your puts, sell them here. Buy them there, sell them there. The rest of the time, forget it. So it's always a second wave to third wave proposition. Because you've got so much evidence. Within this decline, it's 5 waves down, and this rally is 3 waves up. And that's really an after-the-fact evaluation. The interesting thing about entering an option trade this way is that it's very high confidence, and you've got all sorts of evidence because you've already had the signal that the trend has changed. You don't have to buy the exact low and guess the end of a corrective pattern, as an example. You can wait for the first 5-wave move and then enter on the 3-wave counter-trend correction. Okay, this is a good one. When assessing waves of smallest degree on hourly charts, when does one ignore a squiggle and when does one count it as a wave? The answer is never. All those squiggles are there for a reason. He said, I noticed some were ignored in some of the charts and wanted to know why. If we label a chart this way on the hourly chart of the Elliott wave theorist, I have not ignored these squiggles. I've counted them. I just haven't bothered labeling them. When you get down to the hourly chart, if you start putting more 1s, 2s, 3s, 4s, all the way down to the tiniest little things, it turns into a real mess. But every one of those wiggles is taken into account. There's not one that we failed to consider. I'd like to point out something about bar charts for a second. It can be a mistake to look at a bar chart and come to conclusions about the wave count on the smallest observable degree, because there appears to be information on here which is reliable that may not be reliable. If in the bar chart you have an upward close and a down move and an up and a down close and an up and a little down, that doesn't necessarily mean that's 1, 2, 1, 2, or 1, 2, 3, 4, because in reality, even though this little pullback showed up, you had a long trading day where all sorts of things were going on that do not show up on here. For instance, you could see what looks like a 3-wave rally on a bar chart. Let's make that a gap. Now someone might look at that bar chart and say 1 up, 2 down, 3. But you don't know that, because this market could have gapped, run right up here in the opening hour, and traded in a triangle the entire rest of the day and closed right there, and that may well be a 5-wave structure. So don't make assumptions about bar charts. There's a lot of information in bar charts, but some of it can fool you. That's why I tend to count when I use bar charts with 1 degree larger and take the bigger swings. It helps if you can keep an hourly chart, but to do that, you're going to have to watch the screen yourself. Is there any usual time to look for peak volume during a primary impulse wave? Definitely yes. Peak volume usually comes here, in this range, between the center of wave 3 and the peak of wave 3. If you're plotting volume, usually you'll see a big spike right there at the center of the 5-wave structure. Corrections can do a lot of different things with volume, but in a 5-wave structure, this little area from the middle of the third to the top of the third is where you will usually see the greatest volume spike. In a 5th, you will often see a high volume spike, but not as high as the third. That is usually a great confirmation that wave 5 is over or ending. In contracting triangles, do B waves have to hit new highs? No. Can an X wave be a 5? No. An X is just like a B, and it's always a 3. What signals are there to tell you that an extension is imminent? There are none. But if you go under the assumption that the third wave will probably be the extension, you really can't get in trouble. Because most of the time it is an extension, first of all, and if it isn't, you've still got wave 4 and then another fifth to come. And the fifth will be extended anyway. So play for an extended third. How many investors are practicing the Elliott wave theory and actually are self-fulfilling their own market action? Now, this really is a two-part question. And I've had this 1,000 times. You know, if everybody follows Elliott, won't the market go exactly the way everybody thinks it will, because the new buying will cause the uptrend and the new selling will cause the downtrend? All I can say is I sure wish that would happen, because I'd love to be able to say, market, it's time to turn up. And sure enough, it would. Time for a correction. And sure enough, it would. That's obviously not the way the market works, but let me analyze this a little bit deeper. There are just as many people, perhaps more, who say, aren't there so many people following the wave principle now that it isn't going to work at all? And nothing will be right. It's the other side of the coin, this idea that some analyst's ideas is going to affect the movement of the market. Now, that is really an ego-boosting idea, but I'll tell you, the market is so much bigger than any single person or group of people out there that it's going to do what it has to do. Analysts have proven throughout history, when people thought they had, quote, power to move the market, that at some point the market ignored them completely and did exactly what it wanted to do. So in reality, that power, just at the point when they were supposed to be at the height of it, did not exist. Now, as far as too many people following Elliott wave, can you imagine that? I mentioned that study that was done at Yale University asking people how they went about picking their stocks, and 75% of them said they didn't ask any questions. They got a tip and they bought it. If they didn't even find out anything about the company at all, what they made, read the prospectus, or even look at a chart of it, can you imagine them actually learning the entire Elliott wave principle? No way. Particularly as we come to the end of this bull market, they're going to be dragging more and more public types in there, and you people are going to be the wolves, you see, herding all the sheep around. But there are going to be a lot more of them than there are of you. And even among subscribers of mine, among people in this very room, how many do you really think will be taking action at exactly the same time with heavy conviction in the market? Very, very, very few. Even when the signals are very strong. Again, it's one thing to be academically correct on calling the market. It's another to turn that into money by taking action. Very, very difficult. Such a minority of the total people who even know Elliott have the ability to turn that into big money. It will have no effect on the trends whatsoever, good or bad. Do you consider Elliott wave theory a contrarian philosophy? No, not really. Philosophically, it's the opposite. It says basically go with the flow. You're not trying to fight. A contrary frame of mind, a contrary thinker, loves contrary opinion because he likes to be feisty son of a gun. But somebody following Elliott generally wants to be with what's happening and with the trends. However, in terms of market participation, if you're buying lows and selling tops, you are naturally a market contrarian. It has to be the case because more people are bullish at tops than they are at bottoms. Would you please comment on the real estate area, especially in terms of how we can track the wave count on a broad basis? Well, I've looked into that actually, and I know of no index that will allow you to count wave structures in real estate. There just isn't enough good sensitive data out there. So I would say there's really no way to do it except using your knowledge of the personality of waves on a major trend basis. How do you know when a change of trend against the major trend is no longer a correction but a major trend in the opposite direction, i.e. a bull market to a bear? See why it takes me a couple of minutes to read these sometimes. The basic answer is get some perspective. Know the history of your market. If you just start at an hourly chart and you see, 5 up and then a 5 down like this, well, you really don't know what's happening. Now, let me draw it over here because in other words, is this A, B, C, and you're only going to be down for 2 days? Or was it the fifth of a larger degree, and really you're going to be down for a couple of weeks? Or is it a fifth of that magnitude? Or is it a grand supercycle top? If somebody starts an hourly chart somewhere about a week before the high, sees 5 waves up over a week, and you see 5 hourly down, that's going to be one healthy correction. So get some perspective, you know. That'll surprise him, won't it? Oh, can a triangle alternate with a triangle? I think that contains a contradiction in the question in waves 2 and 4. No, there's no alternation there. Now, a triangle can alternate with the flat family or the zigzag family, but not with itself. And there's another reason for that. We mentioned that triangles never, or virtually never, depending on whether you argue over 1 or 2 points in history, occur in the second wave position. They are formations which precede the final move, so they wouldn't show up in the second wave anyway. Yes, it can be part of a combination in the second wave, but then it's a double 3, not a triangle. Oh, this goes back to a question we did touch on earlier, but generally when any one method is too widely used, its usefulness is reduced. What do you think of Elliott and so forth? I even want to challenge that on a more basic level. I have heard that from speakers' platforms for the last 5 years. There's people saying, all right, anytime something's popular, it stops working. My question was, give me 3 examples. Give me 3 examples of indicators that worked real well for a long period of time, and barring mechanical changes in the market that forced the indicator to read something different from what it did before, give me some examples of indicators that stopped working just because they were popular. That's not an indicator. Well, some people would say he's not an indicator. Yeah. And even the people who were following Climax Indicator and all of Granville's work in the summer of '82 were screaming and yelling, this is giving buy signals. Why isn't he? So again, the indicator was working fine. So my answer is indicators that work well will always work well because people are people and they're going to make the same mistakes at the bottoms and tops. If there's a mechanical change in the market, like the introduction of options, and maybe that messes up the short sale ratio, well, that's explainable from mechanics. It has nothing to do with the fact that it got popular. Even the odd lot statistics, other than short sales, it was just the buy-sell, still have a great deal of validity, even after all these years. Fascinating that an indicator that works is absolutely no guarantee that anybody's going to bother following it. If it's a little bit difficult to keep up with, I say, yeah, I need something easier. In a flat correction, does wave C always fall below wave A except in the rare running correction? The answer is yes. Always look for C to fall below A. Failures are terrifically rare in corrections. Please talk about the data needed to make good hourly charts. Well, you can get your hourly data out of the Wall Street Journal. Other data is available all through that Wall Street Journal. Most of it's there. Barron's has some, and most of the quotation services like Commodity Quote Graphics or Quotron have a good deal of data stored up. You have to get their books and read them to find out how to dig that data out of the system. Can diagonal triangles extend? No. A diagonal triangle is a diagonal triangle, period. Extensions can occur in impulse waves 1, 3, or 5. Can extensions occur in impulse waves A or C? Well, they can occur in waves 1, 3, or 5 of C. For example, A, B. There's an extension. So it's still in a third wave, and it could be in a fifth, and it could be in a first. That's where you're likely to find it. But within an ABC, nothing prevents the market from providing an extension on the lower degree. In reference to the personality of corrective waves A, B, and C, what may be different if the correction is a triangle? And do D and E exhibit definite personalities? Well, I almost answered that question, no, but I thought about it a bit, and we have noticed a few things about the last waves of a triangle. The D wave often has a very large burst of volume. We've seen several indications of that. And I believe that that is a hint or a kickoff that something is about to happen. If this is a triangle, you're about to get a thrust. And the D wave in here is going in the direction of the next big move. And sometimes, some stocks, for instance, when there's big volume here, have already turned up and thrusted. And you find a lot of volume in the D, and then you sink back in the E, and of course make everybody miserable, and then all of a sudden you do get the thrust. And there is something worth knowing about E waves as well. The E wave is the last move, and as an example, I'm going to draw a triangle in the declining market situation. One of the pages in the book showed a contracting triangle in silver. And Dave showed how it burst through the upper trend line right at the end, and there was news about the Hunts being out of their silver. Consider a triangle, even though it's sideways, as a rally, because it's counter trend. Remember how we talked about the Dow Industrial Average in the 16-year sideways trend of 1966 to 1982? We said that's a bear market. All those stocks were getting slaughtered, and in real dollar terms it was a debacle and so forth. The same, and that was a sideways move. Well, the same thing is true here. This is a rally attempt, and bullishness usually increases throughout. You'll find the bullish consensus showing more people believing the trend is up here than did here, even though this is a lower level than back here. You'll find the put-call ratios showing few people willing to buy puts in this market. Sometimes the E gives you a little gap, as it did in this situation, and there's good news. Where does good news usually come out? Top of a rally. So keep that in mind for E waves. What do you mean by hourly reading? Well, it's the reading taken upon the hour, and in New York time that would be 10 o'clock, 11, 12, 1, 2, 3, and close. Which brings up another sub-question. How do you get the official hourly reading of the Dow? Some services report the hourly Dow readings right after they come out. And upon occasion, you'll open the Wall Street Journal the next day and they'll be a little bit different. If that happens, and we went through this big flap about 2 years ago with Dow Jones and Company, they swear that their computers are the final word, and that sometimes they're reported early because it takes time for the computer to catch up and make sure it's got every transaction involved, but the officials are the ones printed in the journal. Now, if they transpose numbers, that's different. That's a typing error, and sometimes I can maybe remember 1 or 2 times in the past 10 years that's happened, but most people notice it and they call them up and find out. Here's an interesting question. The question is, can this formation lead to an irregular or be part of an irregular flat correction? 3 waves up for an A, triangle B, 5 waves for a C. The answer is no, because an irregular or a flat, price-wise, has to come back to the lows, or it is not flat. Therefore, rather than expecting 5 waves up to follow that triangle, what would you expect? 3 waves up. So a flat, there's a little section in our book called the right look. Don't call it a flat unless it looks flat, because if you go ABC, ABC, and then 5 up, and that B is way above the previous low or previous high in the other direction, it ain't no flat. Can the wave principle be computerized? Yes. I think it would be hard to do, but it's an objective study. It would require a lot of work, and I'm involved in doing that right now. Could you comment on being tied to staring at machine, ticks, trend, volume, etc., and trading successfully? Do you need to be at your battle station watching, or can you alleviate all this tension and emotion? Well, you really can tailor your trading to the amount of stress you can stand. Some people want to be in front of the machine all day. Obviously, if you're a professional chemist, you can't. Although I do know a surgeon who, over the operating table, has a bank of Quotron machines and futures contract machines. I swear. Now, would you like him operating on you? Look at that silver! Oh my! Oh, you know. This is the truth. The truth. He would call me from the operating room occasionally. You'd hear clink, clink, clink. What do you think of soybeans? You know what I mean? I was very careful to speak in a calm voice. Now, maybe he didn't feel any tension. I don't know. But, you have to assess your own situation there. Certainly, you do not have to sit in front of a machine. Those short-term moves can make you nervous, take your eyes off the real work, and just get in the way. But if you're day trading, you need them. This is kind of an interesting question. When you discussed Fibonacci numbers and the sequence, you started with a bear market. Why didn't you start with a bull? Certainly, if you start with the bear, you can create the Fibonacci sequence. And remember, I showed bear market, one wave, bull market, one wave, complete cycle, two waves, then bear market, bull, and so forth to create that 1, 1, 2, 3, 5, 8 Fibonacci sequence. I gave that some thought also. I don't know if there's really a practical answer, but I think there's an allegorical one. True or not, certainly that can be argued. There are, throughout all sorts of cultures, the idea, whether it's mythology or otherwise, of a fall from grace. The idea that there was a fall, that men used to be in paradise, and they fell from that state to the state that mankind has gotten used to. And I thought that was kind of interesting. It's almost as if to start the spiral movement upward, this spiraling progress that mankind is making through history, he had to start with a drop, a bear market. And it's almost as if all of this movement forward from the caveman days to the present is an attempt to reattain that lost state. I think that is an interesting allegory. Whether there's any truth to it, I think, is up to the individual to think about. But certainly there is some allegorical and cultural evidence that certain methods of progress may have to start with a decline. Decline kind of shakes you up and gets you moving again. Now, a couple of quick things. Someone asked, would I autograph some books? Yes, I'm going right out here. Let's talk a while. I'd like to get to know you. It's been a real pleasure. I've spoken before to groups from the public, and it's great getting together with some people who really know something about markets and Elliott. Thanks for coming. Hope you had a good weekend.
This is the question and answer period. And sometimes this is how the speaker feels about the questions. Everyone see that? Okay. But I'm sure that at least as often, this is how the audience feels about the speaker. But what you don't always know is that that is how the speaker feels. Okay. All right. Where can I obtain information, or what book can I read for semi-logarithmic charting? All you need to know about plotting on semi-logarithmic paper, all you need is that type of paper, semi-log paper. We carry some, if it's not from Keffel and Esser, K-E-U-F-F-E-L, and Esser, E-S-S-E-R, which is where we get our arithmetic scale paper, then I apologize, but I'm not sure of the name of the company right now. If Keffel and Esser do not have it, and you cannot obtain it from a nearby office supply store, just call the office and we will give you the name from the other paper. Please give us beginners the best graph paper to use, Keffel and Esser again. And what we use for page 2 of the letter when we show you an hourly chart of the Dow is number 47-1510. I also mentioned, and I had a question about, any multiples of 4.236 that we had seen. Now, this is a representation of the Dow Jones Industrial Average. This was August 1987. This was October 87. This was the low in October. And this decline was almost exactly 4.236, the wave 3 decline, times the decline from 2733 to 2515. And I wanted to point that out. What charting services do you find most useful in tracking Elliott wave trends? Without a doubt, definitely the charts that come in that have the wave structure already labeled are the most useful. We use, for futures, I like Commodity Perspective. I think it's a great magazine or great chart book. Daily graphs, trend line, are the charts we take stock prices out of for the letter. We'll also use Mansfield from time to time, charts from the CRB, Security Research Bureau, out of Boston, I guess. CRB is out of Chicago, I believe. If you need any of these addresses, we would be glad to provide them to you. Additionally, what is the best source of charts for weekly or daily? Additionally, I would want to mention Horsey charts, which I believe are out of Maryland, and Ned Davis Research, who has just tremendous charts that we use quite a lot of for the newsletter. After impulse wave 5 is completed in a channel, how likely is the ABC correction to break out of the channel? Usually, rarely, or sometimes. I would say it's very likely that that would occur. And here's the question. There's your Elliott channel in a 5-wave structure. How likely is the ensuing correction that occurs, the ABC correction, to break out of that channel? Usually, I would say more often than not, it will take that channel out, because the main reason is that it's a bigger degree than anything that has occurred within there. Can you apply the Elliott wave theory to individual stocks? Since the theory, and it should be called a principle, since the principle is based on the concept of mass psychology and mass mood swings, the larger capitalization stocks, those stocks that are really representative of lots of people's interest, something along the lines of IBM or Kodak, General Motors, sometimes trace out very, very nice patterns that adhere to the guidelines and rules of Elliott. I know some people who've done some work in this area, and I think that what is even more interesting are the Fibonacci retracements. I would say that probably more often than seeing the charts that adhere to Elliott as far as rules and guidelines are concerned, the Fibonacci ratios are equally helpful in looking at individual stocks. My basic thought on that is, if you see a stock and it looks like it's counting and it looks like it's following some guidelines of Fibonacci, use it. Why does the rule of alternation fall under guidelines and not under rules? It is a misnomer to refer to it as the rule of alternation. It is a guideline, and it is therefore suggestive. We have a lot of confidence in that guideline, and we think that it is one that you would rather see satisfied than not when you're counting. The second question is, can the rule of alternation be violated? And the answer to that is no, since it doesn't exist. Okay, wave 3 must never be shorter than both waves 1 and 5. Does that mean in arithmetic terms, or percentage terms, or both? The answer is both. Is it possible to estimate the length of a first wave of any degree? And I would say the answer to that is not really, but you can use the internal wave structure of that wave, because remember, that first wave will subdivide into a 5-wave structure. So within that, you've got the rules and guidelines applying to the wave structure. You've got channeling. You've got Fibonacci relationships. Wave 5 is 618 of wave 0 through 3. Maybe wave 3 is extended. Wave 5 equals wave 1. Wave 5 is 618 of wave 1. All those things we look at, plus alternation on a smaller scale between waves 2 and 4 within what you want to count as a 5-wave structure. Is a type 2 diagonal triangle considered an A wave, or is it considered a pattern in and of itself? It's considered a pattern in and of itself. The only place that we have seen it occur is in an A wave, and it has the properties and exhibits the tendencies that you would expect out of an A wave. Okay, this is a question about triangles, actually. In this picture, with regard to the triangle that completed the combination correction, that finished cycle wave 4, is this a valid triangle? Wave E bottoms below the trend line. Where is it relative to wave C? Wave E can end anywhere that it wants to relative to the trend line. The only rule is that it must not exceed the point where wave C ends. Now, in this case, wave C was roughly 727 on the Dow. That was in 1980, and wave E was August of 1982, around Dow 777. So there was no violation there, and that is a perfectly acceptable triangle. Okay, I wanted to clarify this point with regard to the rule, wave 4 cannot overlap wave 1. Let me state this accordingly. Okay. The orthodox end of wave 4 cannot overlap the orthodox end of wave 1. That's the rule. The orthodox end of both patterns cannot overlap. It is a very, very strong guideline that we suggest that you adhere to whenever it is possible, that none of wave 4 should enter the price territory of waves 1 or 2. Let me draw that. If you see this structure, and you've got it labeled accordingly, and you want to label this as a wave 4, and it comes down in the price territory of waves 1 or 2, wave 1 it would be obvious, wave 2, even if it comes down and overlaps the territory of the irregular B wave, you should bet against that occurrence, or you should not use this count. It would be a lower probability. What would be more likely that you should entertain is that this count, let me draw the picture again over here, instead should be labeled like that. That would be a bearish count. A more bullish alternative would be that you were labeling a series of 1s and 2s. You would choose either of these counts before you should count it in this fashion, with the overlap into the price territory of waves 1 or 2. This is a question about page 263. How did you know to label this waves 1 and 2 before waves 3 and 4? This was best counted as a 5-wave structure. The answer is because this is a 5 up in wave 1, and this is an irregular correction. This is 3 waves up in the B wave for wave 2. Now, you did not know that was, and that's why you were labeling it either 1, 2 or AB, but you were looking for higher prices. But at some point during this rally, when wave C became substantially longer than wave A, when the slope of wave C started to look awfully like an acceleration, you probably started entertaining more strongly that this was a potential wave 3 in progress. Now, you didn't know back here that the CRB was going to 340. But, and that was not why this chart was published in the first place. This was published in Futures Magazine, I believe, in 1980 by Bob Prechter, illustrating that the CRB was probably making a peak up in this area at 340, which, as we know, did. Can you elaborate more on how to correctly label extensions that have similar wave components? And labeling could be done to extend wave. Okay, the question essentially is, how do you know which wave is the extension? If you've got a pattern, if you've got something that's looking like a 9-wave pattern. And the answer is that in the extended wave, you will see the better volume. More often than not, wave 3 will be the extension. Alternation will be a big clue as far as where you should put the extended wave. And finally, Fibonacci will be a big clue as to which wave is the extension, because internally within that wave, you will see, there will be better Fibonacci relationships than they exist if you label the extension in a different manner, and that would be all those taken together would help you to know which wave should be labeled as the extension. Let me reiterate, the message that is carried is the same in any of those cases. If you get a wave that's subdividing into 9 waves or 13 waves or more, that's still an impulse wave and carries the same message as a 5. Are there best situations to look to trade off of? For example, diagonal triangle, fifth of a fifth of a fifth. Those are always good. What others are there? I would say that it depends on the circumstance. There are times when you've done 5 waves up, you're coming down in a wave 2. You've got Fibonacci, you've got extremely negative readings on put-call ratios. You've got a very clean wave structure. You've started back up in a little 5-wave structure. Everything is in place. So it depends. You can get a very clean wave count almost anywhere. Let me say, though, that there are areas where it is not high confidence, but they're still great situations. October 1987 was not a high confidence area as far as what was taking place with regard to the wave structure. We presented 3 counts in that letter. But what we did know with surety was that the best strategy to take at that time was to move to the sidelines and get out of the market with a very tight stop. This is page 236. The question, does this correction for minute wave 2 count A, B, C, X, wave 2, and is it over? No. Is that a different type of correction? This pattern right in here is a zigzag, and it was just too small to stick the letters in on the chart, is the answer to that. This was a zigzag, though. And it was subdivided accordingly on the hourly chart. And that, by the way, was the September 1985 low. Okay. On the hotline, you usually give us wave structure, but you rarely mention the wave count. Can you explain why? Yes. In many cases, if I see a clean 5-wave structure to the upside followed by, let's say, for example, to the upside followed by a clean 3-wave structure down, I will say you've got a clean 5 up, you've got a clean 3 down, and that means to the student of Elliott, look for higher prices ahead. We're 5 down, 3 up, if you look for lower prices. That's the wave structure. As far as the wave count is concerned, it doesn't, it's not practical, because that 5 up, 3 down could be 1 up, 2 down, or it could be 1 up, A of 2 down, or it could be A up, B down, or it could be A up, A of B down. And to mention all of those really serves no purpose. If there is a high certainty wave count that comes along, for example, the diagonal triangle that we're probably finishing for wave C in gold to the downside here, and once that wave C is complete, it will complete intermediate wave 4 of primary wave C of cycle wave X. I'll probably mention that on the hotline. But otherwise, to go through all the alternates would just take up time and not really serve any function. If you're a student of Elliott and I say 5 up, 3 down, you know what I'm talking about anyhow. If you're not a student of Elliott and I give a wave count, then it really doesn't serve any function. Does Elliott wave analysis improve one's sex life? Signed, a lonely adherent. Am I blushing? I don't know. I would my first thoughts on this are yes, in a double or triple 3. So, okay. How long does it take for a beginner correctly to count waves? I talked to Bob about this. Roughly 5 times longer than it does for a professional. The answer though really is a function of your experience with the patterns. If all you're going, if when you're studying Elliott, you're going to take a look at a chart, at a daily chart, you're not going to see as many subdivisions as you do if you're going to look at an hourly chart. And if you take it down to a 5-minute basis, you're going to see a lot more subdivisions, and you're going to get a lot more opportunity to label waves and fit the wiggles into the patterns. So if you're anxious to learn, then that would be my suggestion. The more you get to label, the quicker you'll learn it and the quicker you'll become proficient at it. What is the best source of 1-hour charts without costing an arm and a leg? We plot our charts by hand, and we take the numbers. We have a friend who calls us, or a trader who calls us during the day, and with the hourlies, and otherwise we take them out of the Wall Street Journal and plot them yourself. Is probably the best. And that way you know that the chart is plotted correctly, number one, and number two, you get the experience of plotting it. Okay, there are a couple questions along these lines, and essentially what they're asking is, how do you know that you're still in a corrective pattern? You see, usually when your ulcer starts to bleed, but that's always a good sign. See, it's like one of those good news, bad news jokes, right? But I know we're still in a correction. The way this one is phrased, at the end of an ABC correction, how do you know if you will get an explosive up move or more sideways correction? All right, you don't, but you can get a good feel for whether or not the corrective pattern is over. Now let me draw this example. Okay. I'd like to move this wave 4. Actually, well, we'll leave it like this for the time being. All right, you've got 3 waves up. You've come down in what is apparently an ABC pattern. Now, is this correction over? Well, what are the guidelines and the rules that we've talked about? Mostly guidelines in this case tell you about. Alternation, number 1. Wave 2 is sharp. What's the likelihood that this is wave 4 if it's sharp? Well, not as good as if it were sideways or a triangle. So that argues against this being the end of the corrective pattern. You've got the channel estimate that Elliott taught us to draw. You've got waves 1, 2, and 3 complete. You draw a trend line through points 1 and 3. You draw a parallel line off of line 2. That's a good estimate for the end of wave 4. You've got the previous 4th wave support zone, which I've drawn down here, that you would expect the correction to find support in. You've not come down into that. Finally, more often than not, corrections come down a minimum of 0.236, within of at least the 3rd wave, and I'm sure that's not that, probably 382 or larger, with the exception of waves that are just in an extremely accelerated phase. So instead of betting that this is the end of the correction, more likely what you would see, and let me just make this a little longer so it looks better on the picture. At this point, that wave C is lower than wave E. Now, at that point, it's a much better bet that that correction has ended, because now you've satisfied at least alternation with wave 2, and you've also come over to the channel line. Now, that's just, you could have satisfied a couple different guidelines, but there's a higher probability that this is the end of wave 4. Maybe you've also seen a dry up in volume. Remember, we talked about that during this pattern. So that by the time you get, and this is something we've seen occur very often, by the time you get an E wave on an hourly chart, if you keep hourly volume, you'll see the lightest volume hour that you've seen in weeks. It's very typical for an E wave within a contracting triangle to do that. So at that point, you would say it's a better bet that that correction has ended. Let me draw one other example, because there was a second question that was similar. What is the best way to assess whether 3 waves down is an A wave, or is all the correction, or just A of the correction? Let's say in this case, all you've got is 5 waves down, or is 5 waves up, and you've done a little ABC. That. You don't know whether to label that all of the correction or part of the correction, because you don't have anything to satisfy as far as alternation is concerned. In that case, I'd look more to the previous 4th wave of 1 lesser degree. Let's say you've also started up here to that point. Now, you don't know at that point whether you've begun a new impulse wave or not. But since this correction also, the way I've drawn it, is very shallow and has not even come back to roughly a 38% retracement of the 5-wave structure prior to it, what I would expect to see is 5 waves down like that to complete a flat correction in this case, before you see the market move up again. Do you use Dow volume or New York volume? We look at total New York Stock Exchange volume. I've looked at Dow volume. I know Bob has from time to time. I would say if you use it and find it to be worthwhile, as with any tool, I would use it. We don't specifically look at it. Can wave 2s retrace up to 80% of wave 1 and still be validly counted as the second wave of a potential 5-wave advance? Yes, they can retrace up to 100%, but not more. In a simple ABC corrective pattern, a zigzag, can wave A be longer than wave C? Yes. We looked at an example where wave C was 62% of wave A. If there is an extended first wave, do you expect that there will be a higher chance of a diagonal triangle fifth wave or a failed fifth? I don't think that we have any evidence that would indicate that you should look for that. Do you recommend half-hourly Dow charts to obtain equal segments? As opposed to hourly? We look at everything that we possibly can look at, and we use whatever is the cleanest as far as wave counting is concerned. Finally, how do you calculate the dollar-weighted put-call ratio, and how do you calculate the weighted futures premium? There is the formula for the dollar-weighted put-call ratio. Let me just tell you what it is. This is a summation. We look at the 5 most active options on the CBOE, which are usually the S&P 100. To calculate the dollar weighted, we take the price where the option closed times the volume of the option for each of the top 5, add them together, and that gives you this number. You do the same thing for the calls, and that gives you this number, and then you divide it, and that gives you the ratio. And it's been very helpful. As far as the futures premium, weighted futures premium is concerned, and I'm sorry, and then we take a moving average of that as well, but that's how to do it on a daily basis. And I should say that the idea for the weighted futures premiums, as far as I can remember, came from something that Ian McAvity used to do, or probably still does. What we look at the nearby futures contract and see how much time is remaining until that contract expires, and then take a look at its premium or discount. And we do the same thing with the back month. How much time expires how much time is remaining until it expires, and what is the premium or discount in that future relative to the cash. What we do is take the number of weeks nearby times the premium or discount, I'm abbreviating here, of the nearby contract, and we add to that the number of weeks left until the back contract expires times the premium or discount on the back contract. And you sum that together, and then you divide it by total weeks. And then we smooth it. We use a 10-day. That's up to the individual. That ends my section on questions. I've really enjoyed this weekend. I've enjoyed speaking to you, and you've been terrific. Thank you very much.
First of all, I have to say, I know some of you are probably on tight schedules, and you may have to catch planes and stuff like that. Don't feel, bad if you have to walk out. I've been walked out on plenty of times before. However, I do want to say, for those of you who can stay afterwards, we're all going to be outside. We'd love to talk to you for a while. There'll be some people asked if we could autograph some books. We'd be more than happy to do that. So if you do have the time, we'd love to have you stay around just a little bit. All right, I'm going to go through these as quickly as I can, but I do want to cover some of the most important points. Here's the first one. What instrument would you use purchasing your first home now? Cash would be great. Well, he gave me two choices, though. He said 15-year fixed or a 10-year floating rate. Well, I do have an opinion on that. I think one thing rates probably won't do for the next 5 or 10 years is stay right where they are. I think there are going to be wide swings in them one way or another. Personally, I think that even though there may be some period when interest rates will fall, I think ultimately they could go very high. So what does that suggest? It says that the variable rate is probably a better idea, because if rates are coming down, you'll benefit from that. If they're going to go way up, which I think is a pretty good possibility too, all of those variable rate mortgages, at least the ones I know about, have caps. So you may get it now at, say, 11%, and it may have a cap at 13 or 14, and if interest rates start going to 15, 16, 20, or 30, your bank's in trouble more than you are. And you've actually got a bargain there. So I lean that way. Let's see. Please clarify the current hotline position. Some people do get uncomfortable when the hotline and the market letter appear to be in different positions or are in different positions at the same time. Sometimes an intermediate term situation in the market letter is a 60-40 probability, like now, that prices are likely to go down rather than up. However, if you look at the hourly Dow chart for the past few weeks, you could well conclude that there's a 60-40 probability that prices on a short term are going higher, because if you hold to the bearish intermediate term opinion, which does have a slightly better chance of happening on that basis, you have to include a failure here, a very complex 2 there, which is out of character, and this may weight the short term toward making it worthwhile to take a risk on the long side rather than the short side. The most important thing is either approach must have very close stops and perhaps even strategy for reversing your opinion or your position. I know one trader who made a lot of money in the bull market of 1982 to 1987 by being short. He sold short the peaks of the rallies, and a couple days later, when he decided the big bear market he felt was coming wasn't, he'd cover. And week after week, he'd churn out a little bit of money. Now, if he was the type who liked to be bullish, then he would have made a lot. But he was actually successful doing that. So as long as your approach is objective and you've got your places where you can admit you're wrong, or even in the case of the wave principle, you get 5 up and 3 down, and you were bearish, all of a sudden the market starts to rally, you can say, oh my gosh, so we're going higher, I better cover my short, and you've actually made money because it's below where you went short at the peak of wave 5. So please rest assured that we're taking the most constructive policy always, in our opinion. The one thing we don't want to fall for is trying to present some kind of false image and say, well, gee, maybe people will be upset if we do this, so let's do this even though it probably won't work. People will be happier. I've seen a lot of people compromise that way. I spoke to one market letter writer years ago who said he never writes anything bearish in his letter, ever. And he had all the numbers to prove it. He said every time he went bearish, he'd lose subscribers. All he wanted was markets that went up. He said he's bullish all the time. He'll just pick different markets to be bullish on, but he'll always be bullish. So he capitulated, in a sense, to what would make people more comfortable rather than using what was right. And I hope we don't do that. Okay. Here's a good one. I am invested in overseas markets and don't get high-low close data, only the close. Can I still use Elliott? The answer is absolutely yes. Just plot your closes and realize that you're dealing with one higher degree than the hourly chart might present. Don't try to trade intraday off of it, and you'll be fine. This is a little more sophisticated. If your terminal 5th wave is extended, how would you count or label the ensuing correction, blah, blah, blah. Here's a couple of blanks right here. I'd like to clear up something that I believe is an error in our book, which, of course, quoted Elliott on a certain point regarding extensions. He said that extensions are always doubly retraced. Well, Ham-Bolton decided, as I did when I first read it, that what he obviously meant was 5th wave extensions are doubly retraced because they aren't necessarily if they're in wave 1 or 3. The market can just keep going on its merry way. what that meant was, at some point, the market's going to come back, going to correct most of the extension. And at some point, it's going to come out and make a new high out here. So here's retracement number 1. And the eventual move is going to be retracement number 2. However, what's the point? This is always going to happen. The correction is going to carry you somewhere back in the area of the previous fourth wave, normally. The market then is, at some point, going to mount a new bull market and carry you to a new high. There's your second retracement. So it was redundant. There was no particular reason to discuss that in the first place. Now, Elliott did refer to irregular tops. Those also, in my opinion, are not a separate phenomenon. I've never seen any such thing as a separate phenomenon. What this would be an A, B to a new high, C, irregular correction, and then the market takes off on its next impulse wave. There's nothing unusual about that either. And unfortunately, Elliott's formulation suggested that fifth wave extensions are always followed by irregular corrections, and they're not. So anyway, the idea of extensions being retraced twice you can eliminate as any kind of rule or guideline. It'll happen naturally as long as you apply everything else correctly. All right, this guy's waxing a little bit. This guy, I don't know, he may be worried a little bit. He says if the Civil War and the Great Depression and World War I were just low points in an optimistic upward societal trend, how do you envision the lows in a long-term downtrend? Well, I can only say this. So far, the history of mankind shows that the long-term trend is up. Times have been tough on and off again for as far back as recorded history goes, and even in unrecorded history, I don't think the cavemen always had it easy. So I would just say deal with it, like people have always done in the past. Take it step by step. Understand as much about the potential for change as you can. Prepare yourself in advance and just get ready. I carry this around just for things like this. This is an editorial. And it does kind of show how pessimistic some people can get, or how down on the world. It said, the world is too big for us, too much going on, too many crimes, too much violence and excitement. Try as you will, you get behind in the race. It's an incessant strain to keep pace and you still lose ground. Science empties its discoveries on you so fast that you stagger beneath them in hopeless bewilderment. Everything is high pressure. Human nature can't endure much more. Well, that was written in 1833, at the peak of the modern world, as seen by that writer. With improved availability of data, wouldn't it be an improvement to use a broader index like the Standard & Poor's 500, etc., for wave analysis of the stock market? My answer is no. And the reason is empirical. The Dow Jones Industrial Average works better. It has better five-wave structures, better corrective wave structures, better Fibonacci relationships. I can't tell you precisely why this is, but I do know that the indexes are constructed differently. The Dow Jones is a price-weighted index, and the Standard & Poor's 500 is a capitalization-weighted index. There are others done different ways. Value line is done on a geometric percentage gain or loss basis. Apparently, for whatever reason, the Dow Jones Industrial Average works best. My conclusion about this is that the Dow is the index with which most people identify. So it has a certain ability to influence decisions, which is the reciprocal of the decisions influencing the Dow. If someone is turning bullish for some other reason, he may be buying IBM or General Motors. Someone else may not have had an opinion, but as soon as he sees the tape starting to move up, he decides maybe he'll do some buying. Another person is made up of a different psychological orientation. He sees the tape move up and he decides he wants to take some profits. So the buying and selling is moving the Dow Industrial Average, and the Dow Industrial Average is causing buying and selling among some other people. So it's almost a symbiotic relationship among the crowd. They're watching, each member is watching itself as a group ebb and flow, and is acting and reacting at the same time. I think that's the reason why the Dow reflects Elliott better than the other stock market indexes. To determine the higher degree waves, would it be appropriate to take a moving average to filter out short-term fluctuations? I think the answer is no. I don't see any particular reason why you should. Part of the problem is that a moving average is a time-smoothing mechanism. you can have a wave 2 last, say, 1 day, and a wave 4 may last 2.5 or 3 weeks. So on a moving average, wave 2 doesn't even show up. It hardly dents the moving average, whereas wave 4 lasts long enough to cause a pullback in it. You'll only see 3 waves up instead of 5, but when you go to analyze it, it's a perfect Elliott wave pattern. So I would not use moving averages to smooth prices to determine the wave analysis. This guy's down to earth here. When will the videotapes of the seminar be available, and how much are they? I hope they're available soon. They're going to require some post-production. I'd love to have them by the end of the year, but I certainly can't guarantee it. I'm not sure what the price will be, but I will say this. Attendees to this seminar, this workshop, or any of the 4 prior ones will get the tapes for a cost-plus basis. It'll be probably 1/3 of what we'll sell them for to everyone else. Yeah. See, look at this. You're saving money like crazy here. You've already been able to cancel all your subscriptions and everything else. Oh, by the way, that brings up another point. Speaking about cost, there's at least one person here who took an Elliott Wave course 20 years ago from Ralph Distant. It was in Chicago, wasn't it? And he charged $2,100 for the course. Now, in 1966 dollars, we're charging about 1/3 of that. I think that's pretty good. The last question, this guy says, are there any other examples of Fibonacci that you can give us? And there's at least one. A.J. Frost likes to talk about this one. He says that it was very important to him to discover that in most human bodies, the navel divides the total height into the Fibonacci ratio. And before he married his second wife, he doesn't always say before he married his second wife, but I have a feeling it was. He measured her. And he did say that he wouldn't recommend it for everyone because it led to some unnecessary bedroom activity. But he thought it was worth pointing out, and if anyone would like to try it, they're welcome to do it. We have had a great time in these 2 days. I also have an announcement to make. This is the first time I'm going to mention it anywhere. We won't be putting on any more workshops, at least not involving me. There's a possibility a few years down the road things may change. However, one thing we have had a lot of requests for are essentially one-on-one instruction periods. So we thought we would sit down and see if we could put together a series of tutorials where we'd get together a very limited number of people, classroom size, 10 to 30, and actually have work papers, correct things, exercises, let you do the wave counts, come by and take a look at the work and say, this has got to be changed, here's why this shouldn't have been labeled this way, and so forth. Now, in case you haven't discovered it yet, the people who work at New Classics Library are just great people. I'm sure you've met some of the ladies that have helped set up and get you registered and do all those kinds of things. We've always felt like one big family, and in a lot of ways we feel like you're part of it. So we sure hope you'll come up and say hi to everyone you haven't met yet. We'll be outside for a good hour or so, maybe a little longer. It's been a very enjoyable 2 days. I hope you feel the same, and all the best to you.